morning and welcome back to Metro Morning Live. I'm Jim Griffith with Griffith Financial Services, and thank you for tuning in to You and Your Money. Today we want to talk about taxable versus tax-free retirement plans. There are two systems of retirement planning. One is taxable and the other is tax-free. Taxable retirement plans are plans like 401k plans, 403b plans, IRAs, pension plans, and any plan that you contribute money to on a pre-tax basis. These plans generate what the IRS considers to be provisional income. What that means is that this income will cause taxation on your Social Security in retirement once it reaches a certain level. That tax on your Social Security could be as much as 50% or as high as 85%. These plans also give you 100% exposure to stock market risk. You also get 100% exposure to legislative risk, which means that anytime Congress decides to vote to increase taxes, your taxes will go up and your retirement income will go down. These plans also put a limit on the amount of money that you can contribute to them on an annual basis. For a person that's making $250,000 a year, these plans create reverse discrimination. What that means is that when you can only contribute $19,000 a year to a plan and you're making $250,000 a year, you can't contribute enough money to that plan to replace 85 or 90% of your income in retirement. There's also distributions of the income that comes from these plans is also taxable income. So what that means is that when you pull money out of the plan, 100% of that money is taxed. And also because of the fees and expenses inside these plans that can range anywhere from 1.5% to 2%, the magic of compound interest is overwhelmed by the tyranny of the compounding costs inside these plans. Next, we have tax-free retirement plans. The one that most people are familiar with is the Roth IRA. The Roth IRA is a great retirement tool. However, when something gets too good, you can expect the Internal Revenue Service to place limits on what you can do with it. The contribution limits on a Roth IRA are limited to $5,500 a year if you're under age 50. If you're over age 50, the maximum contribution is $6,500 a year. And then there's the 5-year rule to be considered when it comes to Roth IRAs. What that means, if you convert from taxable to a tax-free position with a Roth IRA, the principal that you put into that account cannot be touched for 5 years or until you're age 59 and a half without incurring penalty and taxation. If you convert after 59 and a half, you can access the initial principal immediately, but you can't access any of the gains until after 5 years. So that brings us to the most powerful tool that we have when it comes to tax-free retirement planning, and that is a life insurance retirement plan, otherwise known as ALERT. It's not life insurance. This is the most powerful accumulation tool in the Internal Revenue Code. We minimize the death benefit, maximize the amount of money that's going into the plan to grow the account. You get 100% tax-free retirement income. There are no contribution limits, so it eliminates the reverse discrimination that high income earners are faced with as long as the plan is designed within IRS guidelines. You have no legislative risk. That's why 85% of Fortune 500 company executives use this type of plan as their part of their retirement planning strategy. You have multiple accumulation strategies. You can use a fixed rate strategy, which is extremely conservative, or you can use a variable contract and get direct exposure to the stock market. The most popular method is to use an indexing strategy, which allows you to participate in the upward movement of a stock market index to, let's say, 13%. Then that is capped out, and then you're able to pull money out of that plan 100% tax-free with no downside market risk. These plans perform a multitude of duties in retirement. One, you get protection, you get tax-free accumulation that grows tax-deferred with compound interest, access to the money before 59 and a half without penalty and taxation, and access to money to address long-term health care needs in retirement. That's why Fortune 500 company executives, along with members of Congress, use a life insurance retirement plan as their part of their retirement planning strategy. Now is the time for you as an individual to take advantage of the same plan. These plans are now available for the average person. So if you are converting forever taxable income to forever tax-free income, consider using a life insurance retirement plan, because it's the most powerful asset accumulator in the tax code. You have the ability to get protection in the form of permanent life insurance, which can be transferred to your heirs upon the premature death, 100% tax-free. Once again, you get the ability to accumulate cash, tax-deferred with the compound interest, and now is the time to take advantage of this plan while taxes are at historically low rates. Right now, the top marginal tax bracket is 37%, so now is the time to look at converting your forever taxable income to forever tax-free income by using a life insurance retirement plan. Stay with us. We'll be back in a few minutes and continue this discussion after our commercial break.
All right, we continue our discussion now on taxable versus tax-free retirement plans, and Jim Griffith joins me now on set. And Jim, great information as always. Why are there two systems of retirement?
Yeah, there are two systems of retirement because most people kind of fall in that medium income bracket, number one. Number two is the 401k plans is basically the default retirement system that we have since they got rid of pension plans. So people that are making $40,000, $50,000 a year, the maximum amount you can contribute is $19,000 a year to a 401k plan. So those people can probably replace 75, 80% of their income. But when you get to a situation where you have a person that's making $250,000 a year, or maybe $1 million or $2 million, and you can only contribute $19,000 a year to a retirement plan, it's going to leave a huge retirement income gap for that person when they retire, and they're not able to replace 85 or 90% of the income that they were making when they were working. So now we need another system that will allow that person to put money away and replace that income when they retire. So you have you have Roth IRAs, which allow you to pull income out tax-free, but the most powerful instrument under the tax code is a life insurance retirement plan. Now, when most people hear that, they think you're buying life insurance, but you're not. We minimize the life insurance, so there's very little money going toward paying for life insurance costs, and the majority of that money is going into the growth account in that policy, and there's no limit to the amount of money that you can contribute to it as long as it's designed within IRS regulations. So now that allows people that are very high income earners to put in $1 million a year, $500,000 a year into these plans, so when they retire, they're able to replace 85, 90%, in some cases maybe even 100% of their retirement income. And the other thing about it is when you retire, it's very important to understand that you need to try to be in a 0% tax bracket, because you've got three buckets of money. You've got money that's in that should be considered to be your emergency fund. Then you've got another bucket of money, which is your tax-deferred bucket. And then you've got another bucket, which you want to have tax-free income. And if you manage them properly, you'll literally be able to retire and be in a 0% tax bracket.
Okay, so why is that 0% tax bracket so important?
It's so important because when you retire, the one thing that you don't need is to have taxation erode your retirement income. So when you need the money the most, in many cases, most people get taxed out of their gourd because the only plan they use is a taxable plan. And so by diversifying this, like we always say, you don't want to put all your eggs in one basket. So by diversifying between a tax-deferred account, a tax-free account, we can balance that so that when you pull money out of that 401k plan, you really want to only have enough money in it. So when you pull it out, you can take your standard deduction and you want that income to be equal to or less than the standard deduction. That puts you in a 0% tax bracket. Because when most people retire, the house is paid off, they don't have any itemized deductions. The only thing they have is that standard deduction.
Right.
And then the other money is coming from the tax-free plan is not provisional income, so you're in a 0% tax bracket, and now you have a comfortable retirement.
Okay, you have a video to show?
Absolutely. Let's take a look at this video because it really drives home just how important it is to take advantage of these life insurance retirement plans, especially now that we have historically low tax rates. Let's run that video.
In these volatile and uncertain times, you need to focus on investments that give you control, options, flexibility, and certainty. And you want to remove both stock market risk and tax risk. And you want a guarantee. And you want it all tax-free. That's a tall order. But you can get all of that with certain kinds of permanent life insurance. Most people think of life insurance as something that pays off after you're dead. That's true. But what if I told you that you could have tax-free access to your life insurance during your lifetime, so you could use it for yourself? You could begin moving large amounts of money from taxable accounts into a tax-free permanent life insurance policy. The money grows tax-free inside the policy. It's harder than ever today to make money on your investments. So the last thing you want to do is share any of your hard-earned gains with the government. You don't have to if those gains are earned within a life insurance policy. If your money's going to grow, it may as well grow tax-free, right? You need to realize that life insurance is an investment, but it's better than your typical investment accounts because it's tax-free. Oh, and one more thing. Life insurance comes with something else that you can never get from the stock market. A guarantee.
Jim, great information as always. Let everybody know where they can find you.
Absolutely. You can get in contact with us at 800-361-6542, or you can go to griffithfinancialservices.com. Leave us a message. We'll get back with you in a short period of time.
All right. You have any events coming up soon, Jim?
End of the month, we'll do our normal Rockstar event, but one thing I would like to say and emphasize today is that today is Election Day. And everyone needs to get up and get out and vote early. Not just the 50-year-olds, not just the 60-year-olds, but we need voter participation from the young generation so that we can make a difference. Makes a huge difference because you guys are the one that will pay the price down the road for taxes going up. You have student loan debt that you're having to deal with now. People are retiring. You're going to look at issues that you have to deal with long-term health care. So make your vote count and make your voice be heard. Get out and go vote.
All right, the polls close at 7 o'clock tonight. We're back after this.